The suitability standard required brokers to determine if a client's investment goals and risk tolerance aligned with the recommended investment product. However, the suitability standard did not require brokers to act in the best interest of their clients. The shift to a best interest standard Reg BI represents a significant shift in the way broker-dealers operate. The regulation requires broker-dealers to act as if they are fiduciaries, which means they must put the client's interests above their own. This is a fundamental change from the suitability standard, which only required brokers to ensure that the recommended investment product was suitable for the client. Key provisions of Reg BI: the regulation requires broker-dealers to disclose certain information to clients, including the type of investment product being recommended, the fees associated with the investment product, any conflicts of interest that may exist, the potential risks and rewards of the investment product. Broker-dealers must also provide clients with a written disclosure document that outlines the terms and conditions of the investment product. The regulation establishes a new standard for broker-dealers to follow when recommending investment products to clients. #The impact of Reg BI on broker-dealers. The impact of Reg BI on broker-dealers. Reg BI has significant implications for broker-dealers. The regulation requires broker-dealers to act in the best interest of their clients, which means they must prioritize the client's needs above their own. This can be a challenging task, especially for broker-dealers who have a financial incentive to recommend certain investment products. Challenges faced by broker-dealers: one of the biggest challenges faced by broker-dealers is the need to balance the client's interests with their own financial interests. The evolution of fiduciary standards. The fiduciary standard has been a cornerstone of the financial services industry for decades. It requires brokers to act in the best interest of their clients, putting their needs and goals above their own. However, with the introduction of the Reg BI, the landscape has changed, and the role of the fiduciary standard is being re-evaluated. The rise of Reg BI, or Regulation Best Interest, is a new set of rules introduced by the Securities and Exchange Commission, SEC, in 2019. The regulation aims to increase transparency and accountability in the financial services industry. Under Reg BI, brokers are required to put the investor's best interest first, but the rules also provide a safe harbor for brokers who can demonstrate that they have acted in the best interest of their clients. Key aspects of Reg BI. Plus requires brokers to put the investor's best interest first. Plus provides a safe harbor for brokers who can demonstrate that they have acted in the best interest of their clients. Plus requires brokers to disclose conflicts of interest. The impact on fiduciary standards. The introduction of Reg BI has raised questions about the importance of the fiduciary standard. If brokers are now required to put the investor's best interest first, is the fiduciary standard still necessary? Fee-for-service advisors are not employed by the financial product providers, such as banks or insurance companies. Instead, they are employed by the firms that provide the service. What is a fee-for-service advisor? A fee-for-service advisor is a professional who provides financial guidance and advice to clients. They work for firms that offer financial services, such as financial planning, investment management, or retirement planning. These advisors are paid a fee for their services, rather than receiving a commission on the financial products they sell. Key characteristics of fee-for-service advisors. They are employed by firms that provide financial services, not financial products. This is known as a conflict of interest. The fee-based model. A closer look. The fee-based model has gained popularity in recent years due to its perceived benefits over traditional commission-based models. However, critics argue that the fee-based model is not without its flaws. The benefits of fee-based models. Transparency. Fee-based models provide clear and transparent pricing, making it easier for clients to understand the costs associated with their investments. Objectivity. Fee-based models eliminate the potential for brokers to prioritize their own interests over those of their clients. Long-term focus. Fee-based models incentivize brokers to take a long-term view when advising clients, rather than focusing solely on short-term gains. The dark side of fee-based models. The dark side of fee-based models. Despite the benefits, fee-based models can also have some drawbacks. The risk of conflicts of interest. Hidden fees. Even in fee-based models, brokers may still receive compensation from product companies, creating a conflict of interest. Limited product options. Fee-based models may limit the range of products available to clients, as brokers may only recommend products that generate revenue for their firm. Overemphasis on sales. Fee-based models can lead to an overemphasis on sales, rather than providing genuine advice and guidance to clients. Fiduciaries must disclose everything to act in clients' best interests. They are required to provide a summary of their services and fees to their clients. This document is a key part of the fiduciary standard. Understanding the fiduciary standard. The fiduciary standard is a core principle of the financial services industry. It requires financial advisors to act in the best interests of their clients, putting their needs and goals above their own. This standard is not just a guideline, but a requirement for all registered investment advisors and broker-dealers. Key components of the fiduciary standard. Transparency. Fiduciaries are required to clearly disclose their services, fees, and conflicts of interest. Conflicts of interest. Fiduciaries must disclose any potential conflicts of interest that may impact their recommendations. Best interests. Fiduciaries must act in the best interests of their clients, prioritizing their needs and goals. The importance of planning in business. Effective planning is the backbone of any successful business. It enables organizations to set clear goals, allocate resources, and make informed decisions that drive growth and profitability.